Startup and organizational costs are a favorite EA exam trap because they look like normal business deductions, but timing matters. These costs happen before the business is officially open. The tax law gives you a special deal. You can elect an immediate deduction and then amortize the rest. The key is classifying the cost correctly and starting amortization in the right month. Startup costs are the getting ready to open costs. Think market research, pre-opening ads, training wages, travel to line up suppliers, and consultant fees. Investigative costs count too, as long as they're part of a general search or preliminary investigation. But startup costs generally do not include things like deductible interest, taxes, or research, and experimental costs. On the exam, watch for pre-opening training and advertising. Those are classic startup. Organizational costs are different. They're the legal and paperwork costs to form the entity. Filing articles with the state, drafting a partnership agreement, organizational meetings, temporary directors, those are organizational. The exam loves mixing these with startup costs in one fact pattern. Your job is to separate them because each category gets its own potential $5,000 immediate deduction and its own phase-out calculation. Here's the immediate deduction rule. You may elect to deduct up to $5,000 of startup costs and up to $5,000 of organizational costs, but there's a phase-out. Once either category exceeds $50,000, the $5,000 deduction is reduced dollar for dollar by the excess. So at $51,000, your immediate deduction becomes $4,000. At $55,000, it's wiped out completely. Anything not deducted immediately gets amortized straight line over 180 months on Form 4562. The start date is not the day you paid the bill. It starts with the month the business begins regular operations. That's why a business opening late in the year only gets a few months of amortization in year one. EA exam tip: they'll give you an opening date like November 1st and expect you to multiply the monthly amount by 2 months. Let's do the quick mechanics. Step 1. Compute the immediate deduction after any phase-out. Step 2. Subtract that from total costs to get the amortizable balance. Step 3. Divide by 180 for a monthly amount. Step 4. Multiply by the number of months from the opening month through year end. For example, if startup costs are $21,200 and the business opens November 1st, the amortizable balance is $16,200. Monthly is $90, and year one amortization is $180 for November and December. Marisol is a self-employed midwife with a home office. Her principal place of business is her home, but she rarely meets clients there. Instead, she travels to her clients' homes and performs her services on site. Which statement is correct? She can't deduct round-trip transportation from home to clients. She doesn't have a qualified home office. She can deduct round-trip transportation from home office to clients, or none of the above? Think about it. The correct answer is, she can deduct the cost of round-trip transportation between her home office and her clients' homes. If the home office qualifies as her principal place of business, then travel from that office to client locations is business transportation between work locations, not non-deductible commuting. The tempting wrong choice is the one saying she can't deduct it. People confuse this with commuting from home to a first job site. Harborview Foods Corporation opened its doors on May 10, 2023, and incurred $53,000 of organizational costs in its first year. How should these costs be treated? Options include a reduced current deduction with the rest amortized, a rule saying they're only deductible the prior year, a full $5,000 deduction with the rest amortized, or no current deduction at all. Think about the phase-out. Answer: $2,000 can be deducted currently, and the remaining $51,000 is amortized over 180 months starting in May. The corporation's $5,000 immediate deduction is reduced dollar for dollar by the amount over $50,000. Here, that excess is $3,000, so $5,000 minus $3,000 equals $2,000. A common trap is picking the full $5,000 deduction and forgetting the phase-out.